Right now, the crypto market is telling two completely different stories at the very same time. On one hand, you've got this incredible wave of euphoria with prices pushing higher. But on the other hand, the actual economic data is flashing some pretty serious warning signs. It's a classic tug-of-war. So today, we're going to break down a professional strategy that's designed to win no matter which side pulls harder. So what's the real story here? Is this big rally builds on something solid, like a genuinely healthy economy? Or is the market just kind of running on vibes, choosing to ignore the flashing red lights from the real world? Seriously, how you answer that one question? Well, that should probably define your entire game plan from here on out. The professional report we're digging into today boils this whole mess down to two possible futures. Scenario A, that's the dream, the soft landing. The economy cools off just right, the Fed starts cutting rates, and risk assets like crypto go to the moon. Then you've got scenario B, the nightmare, the hard landing. The economy actually tips into a recession, everybody panics, and risk assets get totally hammered. Any smart strategy has to be ready for both. Okay, first, let's talk about the good stuff, the bull case. Why does everything feel so good right now? Well, a few key risk-on indicators are all pointing up, painting this picture of just total confidence. Let's look at the data. The whole bull case really starts with the traditional stock market. When the S&P 500 is ripping this hard, it's a huge green flag. It tells you that investors are feeling brave. They're hungry for risk. And that confidence, and maybe more importantly, that cash, it has a way of spilling over into crypto. It's a clear signal people are in a buying mood. Next up, you've got the VIX. You probably know it as Wall Street's fear index. And a reading this low, well under 20, suggests there's basically zero fear in the market. In fact, you could even call it complacency. Investors are so sure the rally's going to continue, they aren't even bothering to buy insurance against a crash. And all that confidence gets a major boost from this. The US dollar index, the DXY, is falling. A weaker dollar is basically like rocket fuel for global assets like Bitcoin. It makes them cheaper for everyone outside the US to buy, sucking in even more capital from around the world. So you put all that together. Strong stocks, no fear, a weak dollar, and what do you get? You get this. The crypto fear and greed index is sitting firmly in greed. It's not at those crazy top levels yet, but it shows the sentiment is powerfully positive. All signs are pointing to the market pricing in that perfect, soft landing. But, and this is a huge but, what if the market is completely wrong? And this is where the story flips on its head, because hiding just underneath all of that green candle optimism is one number. One piece of data from the real economy that could bring this whole party to a screeching halt. And this is it, the July jobs report. The economy added a shockingly low 73,000 jobs. That just blew past even the most pessimistic forecasts. And to make it even worse, the numbers for the 2 months before were revised down by a combined 250,000 jobs. This is not a soft landing. This is the kind of data that signals a recession might be knocking on the door. This quote from the report just nails the danger here. The market isn't rallying because the economy is strong. It's rallying because the economy is weak, and everyone is just assuming the Fed will see these terrible numbers and come to the rescue with more cheap money. A rally that's built on the hope of a bailout, well, that's a pretty fragile rally. So there's the tug of war, right? Market euphoria versus economic reality. So how on earth do you invest in an environment like this? Well, now we get to the fun part, the actual strategy. A specific portfolio built to handle both scenarios, asset by asset. This strategy kicks off with a really strong defense. The anchor of this whole thing is a huge 50% allocation to Bitcoin. The idea is to treat it as digital gold, the one asset that's probably best equipped to handle a storm if one hits. So why go so heavy on Bitcoin? A 50% chunk is a big deal. Well, the report says it's all about Bitcoin's unique resilience. It's got that digital gold story, it's got that perfectly predictable supply, and, this is the big one, it's seeing these undeniable massive inflows from the new ETFs. The thinking is pretty simple. If we get a hard landing, it should protect your capital better than anything else. And if we get the soft landing, it still has massive upside. It's built for both worlds. All right, next up, with a 30% slice of the pie, is Ethereum. This is the portfolio's main growth engine, but that growth potential is being tempered with a bit of tactical caution. I mean, the case for Ethereum is pretty clear, right? It's the dominant platform for, well, for everything. It's got the ETF momentum behind it now, and that huge Pectra upgrade is on the horizon. So why only 30%? Well, the report flags one really important warning. After the big run it's had, it's starting to look a little tactically overbought. And this chart shows you exactly what that means. This is the Relative Strength Index, or RSI. And if you look at Ethereum's bar on the left, its RSI is up at 73. A reading over 70 is kind of a classic warning sign that an asset might be a little overheated and due for a pullback. You can see both Solana and Bitcoin have much more neutral, healthier-looking readings by comparison. The last piece of the portfolio is the high-octane part. This is Solana, getting a 20% tactical allocation. You can think of this as the high-risk, high-reward component, designed specifically to capture some explosive upside if the market keeps running. I mean, Solana's growth is just undeniable. We're talking more than 1.2 million people using it every day. DApp revenue is surging. The numbers are crazy. But it's also the riskiest of the three. It's way more volatile, it has that history of network issues, and you've still got that shadow of the FTX token sales looming. That's why the allocation is capped at 20%. It's meant to catch that massive upside while limiting the risk to the whole portfolio. Okay, so we've looked at the conflict, we've broken down the assets. Let's put it all together and reveal the final portfolio, one that's specifically designed for this weird, unbalanced market we're in. And here it is. 50% in Bitcoin for defense, 30% in Ethereum for growth, maybe buying on a dip, and 20% in Solana as your tactical, high upside play. See how it's balanced? It's built to capture the good times in a risk-on world, but it keeps a strong defense ready for that risk-off reality. Okay, now before we look at the specific price targets, I have to be super clear about this. This is just an explainer. We're breaking down a professional strategy for educational purposes. It is absolutely not financial advice, and you always have to do your own research. For those of you who want the specific numbers, the report also lays out this guidance. It gives you potential entry zones, stop-loss levels to manage your risk, and some clear profit targets for each coin. And notice for Ethereum, it specifically says to buy on dip. That goes right back to that overbought RSI we just saw. So that's one professional take on how to balance all this market hype with some pretty worrying economic news. The big idea is to stay in the game, but play good defense. So the final question is really for you. How are you thinking about this market? How are you navigating it? Let us know. Thanks for tuning in.